But this time I'm going to review a great book called Alpha Trader by Brent Donnelly. So this is a book I came across recently, and it's seemed to offer a lot more compared to other books I have read. So let's look at the introduction. The author means this book to be a very wide he has written for a very wide range of audience, including the kid who just opened a Robinhood account with his $100 pocket money, to a portfolio manager managing billions of dollars in a fund. And the author intends this to be a punchy and practical book. This book has been logically divided into four parts, with each part addressing a specific aspect of trading. So I happened to read the book very quickly. So I would say I just jumped into the sections which I found most interesting or appealing. So I guess I didn't have much problem traversing through the book in that manner. But if you are systematically willing to put in the effort, I would say rather go through it sequentially. Part one is a very general section. It has general reasons for failure, and part two is on the mindsets, positive traits. Part three is on the mathematics, methodology, the probabilistic nature of trading, Bayesian thinking, and all those things. And part four is more on the adaptation and attitude. So these are just logical classifications, but each part cuts across through the other, because, as you know, trading is not just one discipline; it cuts across disciplines. So this book definitely proves that. So going on to the part one. So part one is about more about knowing oneself. It's about how you behave. How are you placed in terms of your behavior? Are you very impulsive? Things like that, very behavioral questions. So there is a specific test actually, which is big five personality trait test. So this as per this test, it aims to test four qualities: openness to experiences. So whether you are as a person open to new experiences, or you are in a shell. Conscientiousness, extraversion. Conscientiousness and extraversion are again very specific. Are you an extrovert or an introvert? Agreeableness, are you flexible enough to change your thinking? Neurotism, all those things. So basically it's also an offshoot of the BMT test. But the author feels this big five personality traits test is going to be more helpful from the trading perspective. And there are also lots of aspects given about how to be more organized, self-disciplined, persistence, etc. So the author talks a lot on persistence in this section. So he even recommends a couple of books, like one of it is Grit, which I think I remember that book. I think another book is by Peter Hollins, which is on self-discipline. At the end of the chapter, there are 10 action points. So this whole chapter is pretty good, and it's also a chapter which you might keep coming back to. So that way, it's a pretty nice chapter. So as you see, the conclusion of this particular success in trading, he has boiled down to a few qualities like conscientiousness. So conscientiousness is about being more organized. IQ, which is the general intelligence. Talent or skill, that is given, like how skilled you are as a trader. And luck, of course, there is an element of luck involved everywhere in life. So in trading. And neurotism, here the neurotism is viewed as a negative aspect. So in the sense that whether you are very subject to your emotions. So that is how he has boiled down the success equation into. So moving on to the second chapter, this is on the alpha trader mindset. So it's a level up. It's more about leveling up your self discipline. As you see, you would have already seen some traits, and it looks deeper into these winning traits. So the winning traits, as per the author, are these: rational. The trader has to be rational. Obviously, buying something at a very uh, obscenely valuations, that is not rational. Then intelligent, knowledgeable, informed. So it's given, it has to be there. Then quantitative, the trader should have some amount of Bayesian thinking or probabilistic thinking. Then calibrated confidence. So this is what this means is you should be confident but not reckless. So that is what is calibrated, confident, decisive but not aggressive, independent thinker, which means again you have the ability to think independently, flexible and open minded. So a trader like I've known this proverb which I read somewhere else. So strong opinions weakly held. So traders usually should have very strong opinions, but they should be ready to change those opinions rather immediately upon any new event or when they come across something new, new information. So that is what is on the flexible and open-mindedness. Being creative. So the author talks a couple of examples where he was able to identify the correlation of a currency, New Zealand dollar, with a commodity which New Zealand exports. I think it's cattle. Then curiosity, of course, like other disciplines, success in trading would come to a curious trader, and growth mindset and other behavioral aspects on grit, perseverance, and mental endurance. So one thing I remember about this grit, perseverance, and mental endurance is if you play a game of heads and tails and you toss it for 200 times, there is a very highly likely chance that you will get many hits or many tails in a row. So same thing in trading. So you might have many losses in a row, and the way you are able to maintain your perseverance and survive these bad times, that is also a very important trait of a successful alpha trader. Then he also talks about a lot of self discipline, like how to improve your self discipline. Uh, Definitely, the aspect of self discipline is very important in every other discipline, but of course, even but in trading, it is more so. Being bad at self discipline is going to cost you someday. It may not come tomorrow or day after tomorrow, but someday you are going to pay for it. So courage, decisiveness, focus, patience, all these things are like talked about at length. And trust me, it is not really. It's very interesting. The way he has put it is quite interesting. But I believe you will get it only after you read this chapter a couple of times. And there is one aspect where he talks about two things: raw trading instinct and passion for trading. So raw trading instinct is and the X factor, which cannot really be explained. So as per him, maybe someone like Jesse Livermore had this raw trading instinct. Though in the end he might not be very successful, but he had that instinct. And also the passion for trading, it's something else which can be developed. But that raw trading instinct is some kind of an innate quality. So even if a trader doesn't have a raw trading instinct, but he compensates for that in other areas, he's going to be definitely very successful. So moving on, so there is another chapter on kryptonite. So here he talks more about the negative habits very deeply. So having bad discipline as like no self discipline, bad discipline, that is one of the most uh, negative habits. Not having enough edge. So a trader should be able to explain his edge. So some traders have explained that uh, they cut loss instantly. So very superior risk management is an edge. Some traders are rule driven. So they say it's system driven traders with no emotions. That is another edge. So every trader should be able to explain his edge or know his edge. That is one of the negative. If he doesn't know, that is one of the negative habits. Then over reliance on simple indicators. So any trader who just bases his decisions on simple indicators, such as I'll buy this stock, or I'll buy all stocks which are above the certain moving average. So are keeping very simple indicators for entry and exit may not really be great in the long run. Maybe still with very superior risk management, someone can still make money there, but definitely it's not a great. It's not a trait of a great trader. And too much focus on ideas with no or less focus on risk management. That's another negative habit. Then being emotional, and also getting frustrated very quickly, and acting with euphoria. These are all the negative habits which this chapter elaborates. He also talks about three of his personal mistakes. So one is on Nasdaq, where he failed to see the bubble burst. So I think he never thought the party would end. That is one. Then Abenomics. This is about the Japanese trading, the Nikkei. which started rallying since 2012 after the new president Abe, Mr. Shinzo Abe, started a lot of economic measures to boost the economy. Apparently, I think he was trading the Japanese market as well, so he might have failed to notice this trend. And then sprinting out of the gate, I think it's more about just getting out of your strong areas and venturing new things very rather aggressively. So that is another negative habit which he talks about. Then in part two, also he talks about smart people's and stupid mistakes. How smart people make stupid mistakes. Here he talks about a lot of qualities like overconfidence, over trading, confirmation bias, extrapolation, both on the positive and negative side. So favorites versus long shots. So this means that instead of betting on a favorite, you some traders tend to bet on very long shot ideas, which have very low probability of successful. Even they know that, but they are somehow they internally they feel that they will get that. Then a round number bias. So some traders have this tendency that they will sell only after it reaches 100. So at 99 or 99.5 they are not ready to sell, and then maybe that stock or a bond goes down all the. So and then there is also another quote I read about in this chapter. Chaos is not dangerous until it begins to look orderly. So I like this quote a lot. So this is by Max Gunther. He has written in the book called Zurich Axioms. That's another book which I definitely love. I want to read it again. I have read it a couple of times, but I feel I have lost out on it. But I'm planning to read it again. Okay, and then other things like anchoring and herding. Herding means again going into the same stock or a security which every other person on the street is talking about. So these are some of the mistakes he talks about. Then part three is more on the methodology and mathematics. He talks a lot about the microstructure in the first chapter. So, microstructure means it's about understanding the market, the participants, the liquidity of the security or an instrument which the trader is trading. So, gap risk is something like suppose you bought some stock at 100 today and you just happily go and sleep. If you have put more than 50-60% of your net worth in that stock, tomorrow, if it just opens at 50, what do? So that risk is definitely there. It happens and it has happened and it will happen again. So that is where diversification and position sizing come into picture. So how do you manage the gap risk? And talks about volatility, both the historical and implied volatility. So implied volatility would be something which you get from the option data, option pricing data. And yeah, he talks about understanding the narrative. So you it's important to know any instrument in which stage is it trading. So whether is it under the radar, that is stage 1. So stage 2 is where there is low accumulation, so momentum is building up there. Then stage 3 is the primary trend of the instrument. And then stage 4 is something where there is some amount of initial cracks in the thesis. Then stage 5 is where the euphoria hits and the instrument goes to an all time high, and then it peaks out in stage 6. And by in stage 6 it starts coming down, and by stage 7 hardly people talk about it. So this is a very common thing, and it happens in most stocks except in those steady compounding stocks. It's virtually there in almost every stock. So like some examples which you can definitely think are Cisco in the US, which happened, and like in 2000 the market cap it reached. I think even now it has not reached it. But yeah, definitely some of them don't really go through it, and then there will be another stage again. So it's just a general blueprint. So for example, Amazon or Apple, they have come back, and they have come back like really strong. So it doesn't mean that once the stage 7 a company or a security reaches stage 7, that's the end of it. But this is the general blueprint of any movement in the stock market. So this is about understanding the narratives. Then he also talks about a lot of technicals and life cycle of a trade in the part 3. So there are a few reversal and symmetry and reversal patterns. So some examples are like the rising wedge, where it keeps moving up, but there is a clear wedge, and there is also some kind of a momentum or an energy, potential energy built up in that. So after this wedge, usually it comes up, there will be a reversal. Then dojis are those candlesticks where there is a lot of movement, but in the end there is no change with respect to the previous previous opening price. Then hammers are also like very similar to dojis, and they usually come at the reversals. And he talks about moving average, 200 moving average, 200 hour moving average, and the crossovers with the 55-hour moving average. And finally, he also talks about some indicators like RSI, relative strength, and deviation. So overbought, oversold, those things. So this chapter is something which is definitely a good primer on technical analysis, and very practically it has been mentioned. Then there is a lot of talk about sentiment and positioning data. So how do you understand about any specific stock or a security? It's about general talk. You hear people talking about that. You see social media handles. You see option data. How people are really talking about this and what expectations are being built up. So reading this positioning data and sensitive sentiment is quite helpful. And then in the last section of bringing it all together, other extremely important aspects of a trade such as idea generation, position sizing, tactics are all detailed out. Some of you might find it very like if you already know about position sizing, you know, like okay, there are certain catch here and there. But yeah, this book I liked it quite a bit. Position sizing and tactics were my favorite sections in this chapter, apart from the first chapter where he talks about the technical analysis. Then the final chapter is more on the behavioral aspects. So it's about adaptation and attitude. So how you are able to adapt to the changing market conditions. So I have heard of an instance where there were a lot of floor traders. They had a very difficult time adapting to the electronic trading because the floor traders were more aggressive people. They were driven by they were wired to read the emotions of other people, and their best days were based on reading these other people. So in front, when they sat in front of a screen, they found it very difficult to trade successfully. So that is where that is an example where like some of them definitely did, and some of them have even founded trading companies. So if that is where the adaptation comes in. And then the correct position sizing. So he talks about a case where bad traders always put up the same position sizing. So irrespective of the market condition, irrespective of your previous wins or misses, having the same position sizing might not be a great idea. So if you are having a good streak, it might make sense to increase the position size incrementally. And if you are having a losing streak, it's always good to trade lightly. So that is what I think he talks about. Then there is also again some self evaluation, and he talks a lot about the passion for trading. So this chapter is also pretty entertaining as well as educating. Then conclusion, there is a lot of there is a section where at the end where he talks about the reasons for success and reasons for failure. Don't miss that section. It's in the appendix. So if you just think and reflect just in that one chapter alone, I think it's going to help you a lot. I think I need to do myself. I need to read that again, and I need to reflect on my mistakes. That's going to help, I guess. Then coming to this conclusion, there are a couple of important things like risk of ruin. He advises don't blow up. So even though it's very commonsensical, everyone knows that, but it happens all quite frequently. There is a risk of blow up many times, and it's okay to be wrong. And I have written that okay a few times with little money, but that's what I think. Then a trader should know how to deal with the variance. Definitely you know that okay trading is not a linear game. So there should be a way to handle this variance, and there should be something outside trading a person or a trader should do, which gives him some kind of a focus, and it keeps him motivated all along. And no single method works all the time. I think this is something which all of you know. And finally, yeah, trading should be fun as and most times it should be fun, and it should help you make money and make a living. So that is what trading is for. And finally, I felt okay, this book was a great book in terms of refreshing a lot of trading classic trading techniques, some ideas, some pitfalls which we fall for. And then stresses the importance of reading, keep reading as much as possible all the time, and building a network, human network, where you can exchange ideas, where the other person can think of any loopholes in your idea. Then probabilistic thinking, this is one thing which definitely is going to be very important. And the most important things are which I it got were more on the self discipline part, being decisive when things line up, and then being self disciplined no matter what. Never lose that self discipline. This was the major takeaway for me from this book. I think I'll be definitely returning to this book many times. And this is like a book which encompasses all aspects of trading. Though he might have taken ideas from various other books, this is one book which has comprehensively managed to nail it. So I would say just go ahead and read this book and study this book as well.